So I have a suggestion for you. Next time when someone tells you that this company is the next Tesla or this stock is going to the moon because their company is gonna make tremendous profits, ask them this question and this question first. Show me the money. See, the most important thing for you to understand, if you want to take just one thing from this whole course, take this. Cash flows is the single most important thing when you're trying to find good quality valuable companies. People think that profits are what determines how valuable the share is. Nothing can be farther from the truth. The reality is, it is the ability of your company to generate cash flows, not profits, that will actually determine the value of your company. The reason for that is because profits can be manipulated. How? Through bogus sales, showing revenue expenses as capital expenses, expenses as liabilities. But it is really difficult to fake cash flows. Let me try to make you understand in another way. To understand this, think of the big picture. Take a step back and think, what is the role of accounts in a public listed company? Actually, it is basically a way of telling what is happening in the company to the people who have invested in the company, that is shareholders, by the people who run these companies, that is the management or the board of directors. But here is an open secret that no one tells you. Almost every single company in the world, in some degree or another, cooks their books or manipulates their numbers. Why is that? Because in a public listed company, the management and shareholders are usually two different sets of people. And management incentives are always linked to the performance of the company. So, what is the first thing the management will manipulate to look good in the eyes of shareholders? It will be profits, right? So, then comes the question, how do you find the truth as an investor? That is, you, the real owner of the companies, when the books are being cooked and you can't find the actual profits. Well, you look at the cash flows of the company. See, cash flows are available in something called statement of cash flows. Let's look at the Apple's statement of cash flows to further understand this point. So I have taken here a condensed consolidated statement of cash flows. You can take practically any cash flows. The format all around the world is usually the same. See, first of all, we have to understand that a statement of cash flows is basically divided into three parts. The first part is cash generated by operating activities. That is, how much cash the company is generating from its operations. The second part is cash which is used in investing activities. That is, let's say if the company is earning this much cash, so how much it is putting back in investing activities. And the third one is how much it is paying back to its capital holders. That is debt and equity holders. That is called cash used in financing activities. So these three things, cash generated by operating activities, cash used in investing activities, and cash used in financing activities, will give you a snapshot of what happens to cash during the whole period of this cash flow pertains. In this case, it's a cash flow for the period 6 months ended on 26 March 2022. So first, we will start with the opening cash balance. And when we will do all of these activities, what will happen? You will get the closing cash balance. Our purpose is not to match the opening or the closing cash balance. That is a role of accountants. What we are here to understand is what really happened during the year to cash. Like I said, the most important thing for you to understand as an investor is to understand cash flows of the companies. So how to do that? So first of all, we start with opening cash balance of Apple, that is $35.9 billion. Then we take the net income which the Apple earned during the period, that is around $59 billion, we all know Apple is a very, very profitable company. Now, what we will do is we are focusing on cash and not just this profit figure. So, what we will do is we will take those expenses which are non cash expenses. And what we will do is we will add those expenses in this profit because the purpose is to find cash balance. Now, we will add depreciation, share based compensation expenses, deferred income tax expenses, and some other non cash expenses. So these four things are basically non cash expenses which have been added back because they are not actually expenses on which any cash has been incurred by the company. The important word is we add back non cash expenses. After that, after adding these four things, we get the income, the operating income, which Apple earned in cash. But there is one important aspect of cash flows which almost everyone ignores. It is cash generated from the working capital operations of the company, or what is called usually changes in operating assets and liabilities. What is this working capital operations? This is the cash generated from day to day operations of the company, like cash received from your debtors or account receivables, cash received when the inventory is sold, or when the cash is being paid when the inventory is increased, or when the creditors are paid, basically the non-sexy stuff. You will see that we started with a net income of only $59 billion. But when we make these adjustments, the cash actually generated from operations by Apple is actually $75 billion. So this is the power of understanding the cash flow statement. Then we see that the Apple is investing this $75 billion basically in two things. What are those two things? Let's read them. First is basic, if you look at the first three things, it says marketable securities purchase. Proceeds basically means sales from maturities of marketable securities, and proceeds from sale of marketable securities. Actually, these three things are nothing but the amount which Apple has invested of its excess cash flow. That is, Apple had 75 billion generated during the year, and it put around 61 billions in purchase of marketable securities. That is just like we put our savings in treasuries. Apple has put that amount in US treasuries and other marketable instruments. It has invested $61 billion of in money, almost 62 billion, and around 42 billion have been matured during the year from the investments made during the year or before the year. That is, during the previous year. When you add those up, these are basically the investments. These are the cash flows, net cash flows, which Apple has invested in your investments. The other thing in which Apple is investing its money is basically payments made for acquisition of PPE, property, plant and equipment. Basically, Apple has invested around $5 billion of its money in purchasing capital assets for the company. And it has made some small business acquisitions of around $167 million and some other acquisitions of around $568 million for acquiring other companies. So, Apple is basically investing its $75 billion into these two things. What are the two things? The first is marketable securities. Basically, that is just putting some amount of that is putting your amount earned in some savings. And the other thing is investing in capital assets for new plant and machinery or investing in other businesses. So after the investing activities, how much money Apple has left? 75 billion minus 25 billion. After investing activities, Apple has almost $50 billion left. So what it does with it? Almost all of it, as you can see, around $56 billion is paid back to the investors in the form of what? In the form of this repurchases of common stock of 43 billion. What is this? This is basically share buyback. This is just another fancy word for share buyback. That means Apple buy back or bought back the shares from its investors, and it's repaid the dividends to its investors of $7 billion. So almost the entire amount of $50 billion has been repaid back to shareholders, since a very small amount of debt is on the Apple balance sheet. Do you understand what it means when I say that Apple has repaid almost the entire amount it has saved back to its investors? It actually means that Apple doesn't have enough opportunities that generate the high return on capital. You remember the return on capital we calculated of Apple? It was 86.22%. And they accordingly decided to pay the cash back to investors instead of reinvesting the same in its business, because they know that they will not be able to generate such a high return on capital of around 86%, and they decided to repay the money back to its investors. After repaying that money, it almost pays around $6 billion of its debt and taxes. Now, what it shows us? It shows that Apple's net profit was around $59 billion, but it was generating an additional $15 billion of cash by just managing its working capital very efficiently. In fact, this is one of the biggest contribution of Tim Cook, the most overlooked Apple CEO. This results in operating cash flows being higher than the net profits. So if you have to look at one thing, look at this: cash flow from operations. See, income statement is messy. It is full of accounting tricks done by management or some other people. So, whenever you're trying to find a good value company, look at the cash flows of the company.